we're probably in still early innings, or I think that we have a very, very long runway here. And of course, the story has changed. And when the story changes and the evidence changes, you have to change your opinion. Bottleneck is how long it takes to develop the mines, and the price incentives to pull it out of the ground are not there yet. You have fully allocated production costs that are way, way higher than those all-in sustaining costs, and those have to be factored into the contract terms. The US did establish a strategic uranium reserve. Christopher Wright, the Secretary of Energy right now in the current Trump admin, is breathing fire about energy and specifically nuclear energy.
Justin Huhn, founder of the Uranium Insider, it's a true pleasure to host you on Palisades Gold Radio today.
It's very good to be here with you. Thank you so much for having me again.
Excellent. Excited to hit the ground running, talking uranium, of course. We're in the midst of an incredible bull run, started around 2016, and the returns for the commodity have been absolutely staggering. Now, in November 2025, Justin, from your perspective, where are we within the bull cycle for uranium?
That's always a difficult question to answer. And I obviously have answered this based on market themes and where I saw things going at any particular time, many times over the past years, because I always get asked that, where are we in the cycle? The commodity itself, spot uranium, let's say, bottomed in December of 2016. So it's been 9 years since the bottom for the commodity. Now, I'm not necessarily one to say that a bull market starts as soon as the falling stops. I don't necessarily think that's the case, especially when you look at like technical charting. Usually a bull market will be when something is trading above a rising, let's say 200-day moving average, a rising 200-day moving average. That's bull market territory. So if we chart it like that, we've been in a bull market for the commodity for probably about 5 years, maybe 6 years. Where we're at now and where we're going is a little bit more complex, but I think that we can plant a flag relatively easily based on what we're seeing in the supply and the demand fundamentals and the dynamics, structurally. So the demand story has been a massive story, especially over the past 2 to 3 years. And what we've seen essentially largely being driven by the growth in electricity demand that we're seeing in many countries around the world, but also driven by sovereign policies, energy security concerns, clean energy mandates. All of these things have been, for lack of a better word, bullish and supportive tailwinds for nuclear energy. So if you rewind about 5 years, the sector was still projected to grow, but that growth trajectory was more like 1% to 2% compound annual. Now we're looking at about a 4% compound annual growth rate for actual nuclear energy capacity globally. To give you one idea, and this was brought up by friend and colleague Mike Alkin, who's the managing partner of Sachem Cove. They're a uranium specific fund. He pointed this out in an interview he did a couple of weeks ago, which was the World Nuclear Association's biannual fuel report. They put that out every 2 years. They just did one back in September, comparing that one to their fuel report in 2019. And they have 3 different scenarios, right? Lower, reference, and upper. Reference is to say what they believe is the most likely to be accurate that time will prove. So the 2019 reference scenario compared to 2025 reference scenario, the 2025 reference scenario shows a demand of uranium in 2040 50% higher than 2019. That's how quickly the sector has shifted to a more significant growth story. So the demand has been unbelievably de-risked. And what makes this commodity investment in this industry interesting and unique is that while it's definitely an exercise in data mining and an exercise in patience, it is relatively easy to see what demand is there for reactors right now, and what it will be over the course of, let's say, a 5 to 6 year period. So beyond that, you have to do multiple plugins in your models. But going out 5, 6 years, you know that everything that's operating, you understand what will be life extended, pretty high confidence, what will be shut down. Then you understand that everything that's under construction, not everything, but almost everything that's under construction will be operating and brought online over a 5, 6, maybe 7 year period. So the demand is pretty easy to actually model. And that doesn't really change that much. Now the broader narratives change. So when you're projecting out to 2040, like I just mentioned, for the World Nuclear Association, that's a 50% bump over the last 6 years. It's absolutely huge. But to actually say this is what the world's nuclear capacity is going to consume this year, next year, and going out 5, 6, 7 years, you can say that with pretty high confidence. And then the supply side is even smaller. So while the demand side, you've got 450 something reactors, the supply side, you've got 24 mines. and it's pretty easy also to say this is how much we expect to come out this year, next year, and going out a few years. These mines are coming offline. These are the ones under development. Everything else you have to make plugs. So while, like I said, while it will take, a couple thousand hours to produce relatively accurate models, anybody can do it. And if you have money on the line, you either should be doing it or be paying somebody like us who's done it for you. And that gives us a snapshot of what we're looking at supply and demand. So that's super, super unique. And this isn't a market where the supply of the commodity is cornered by China. They're a very small player, relatively speaking. Not very small, but they're not in the top 5 of the miners of the commodity. And most of the uranium that comes out from China is operated overseas. So they have very little domestic uranium. They've got a big mine in Namibia. They have joint ventures in Kazakhstan. That's their primary uranium production. But it isn't something like lithium or nickel or rare earths where they just can flip a switch and all of a sudden the market soars or tanks based on what China is feeling that day. This market is unique in that way, and it's very unique amongst commodities with the relative lack of influence on the commodity itself by China. The other thing that makes it unique is you don't have something like OPEC just saying, okay, we're going to cut, we're going to ramp, and sending the stocks up or down 10, 15, 20% over the course of a couple of days. Now, we have volatility, don't get me wrong, but it isn't influenced by one or two big players saying something, generally speaking. So for us, that gives us an enormous amount of confidence in where this market is going to speak generally, with, of course, the admission that we have huge volatility to the upside and the downside in the interim. Overall, we don't see what's going to stop this price trajectory. We don't see where the supply is going to ultimately come from far enough down the line to outpace demand and actually stem the rising price and send the price back down. That will eventually happen. We just don't know when or how that's going to happen. So for us, the outlook is fantastic. Where are we in the cycle? I hate to just throw out the baseball innings example because I've been wrong every single time I've said that. When Sprott first had the ATM and took over UPC back in 2021, and we saw a few $100 million pour into SPUT over the first 6 months of the ATM launch, we're just like, all right, is this going to spike to 150, 200, and then we've got multiple years of consolidation? I don't know. That could have happened at that moment if the capital kept flowing. Now, the capital didn't keep flowing, and we still had a decently long consolidation. But I thought, if you had asked me in October of 2021, I would have told you we were in inning 3 or 4, maybe even 5, because of the flows that were coming in, and the spike was likely incoming. You ask me again 4 years later, I'm going to give you probably a similar answer. We're clearly not in the first inning, but we're very obviously not in the final innings for multiple reasons. The price still needs to go higher based on actual fundamentals of supply in the industry. We are not reaching any sort of supply parity at $75 uranium, $85 term. It's not happening. The other reason is if you look at the equities, nobody wants the small caps. Barely anybody wants the mid caps. It's all meme stocks and large caps. So this is not evidence of the final innings of a commodity bull run. So we're probably in still early innings. I would still say maybe inning 3 or 4. I think that we have a very, very long runway here. And of course, the story has changed. And when the story changes and the evidence changes, you have to change your opinion on things. It's ridiculous to stick to the same opinion when everything around you has changed. Whether it be the war in Ukraine, whether it be the COVID disruptions, whether it be this massive electricity demand growth that's happening, largely being driven by data centers and AI. But all of these things have led to a confluence of factors that are very, very large tailwinds for the sector. And I think we're headed way higher, and we could have many, many years ahead of us of runway.
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades Goldcorp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI, with equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a significant stake in newfound gold. Palisades offers investors powerful, leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisades shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisades.ca and join us in our mission to level the playing field for investors. Now, back to the show. Incredibly interesting, Justin, and so much to unpack there on both the supply and demand side, definitely. Before that, I would love to get a 30,000 feet bird's eye view of the uranium market. Who are the key players? Perhaps also explaining how uranium is being traded and how currently, as a snapshot in 2025, supply and demand is currently balancing.
Okay, there's a lot of questions there. So who are the key players in what element? As far as the mining companies on the supply side, is that what you're...
Definitely, yeah.
Okay, so this I really think is something that, and remind me of the other questions in a couple of minutes, because this is going to take a second to unpack. The biggest players in the world are Kazatomprom. That's number one, and by a decent amount. They produce about 34% of the annual demand. So Kazatomprom, Cameco is number two, Orano is number three, Uranium One, I believe, is number four, and then China is number five. I might be mixing up Uranium One and China, but it's in that ballpark. Most importantly, I would say on this story is when we look at a pipeline of projects for the biggest producers, that's really what is influencing where we believe this market is heading. And so let's start with Kazatomprom. Kazatomprom is an in situ recovery miner. So they don't have a big open pit mine. They don't have a complicated underground mine. They basically have uranium held in sandstone aquifers, and they extract it with injection and recovery wells. And they've been ramping production like crazy from the early 2000s, where they were producing almost nothing, to producing 66 million pounds at the peak in 2016. And they backed off from there. They went public. I believe it was 2018, partially public, where they claimed they had and still have a value over volume strategy. So no longer are they trying to produce as much as they possibly can, which in hindsight was probably a pretty stupid thing to do, especially as a state-owned company. They had and still have, but really had in the 2010s, a rapidly depreciating currency, the Kazakh tenge, and they were selling in US dollars. So that was their primary objective for producing as much as they did, was producing in this depreciating tenge environment and making a lot of money. But arguably, they've produced most of their best stuff already. And they have a few assets that are very long-lived, one being Inkai with the joint venture with Cameco, which is a fantastic asset. But looking at their pipeline, they have a decent amount of expansion that's possible, but that expansion is best case scenario going to maintain production levels. It's going to be very difficult for them to ramp, and my understanding from speaking with the company is they don't necessarily even want to ramp, even in a higher price environment. And I think that they do have some pressure coming from some of their state-owned joint venture partners, particularly the Russians, because the Russians are very short uranium. They have a huge order book of nuclear exports. They have the most conversion and enrichment capacity, but they have limited uranium resources. So they're very short uranium, and they're pushing very hard to expand their JV, their big JV, the Budanovskoye project, 6 and 7. And that's a little bit of tension there. But look, Kazatomprom is going to be able to marginally increase production for a handful of years. And then at that point, even admittedly by the company, they have pretty rapid decline rates. Last note on Kazatomprom, if you read, they put out an annual report called the CPR, the Competent Persons Report, and that goes into very, very minute detail on all of their projects. And they have this graphic and these notes within this report where they show expected production going out pretty far, like going out to 2040. And what they're essentially saying is they're going to have to spend a very, very large amount of capital. At the top of my head, I don't remember how much it was, but it's in the hundreds of millions, if not more. In order to be able to expand their project sufficiently to be able to produce at a level that's roughly 20% below where they're at today in 2035. So about half of the projects in Kazakhstan start to, if they haven't already started to decline, they start to decline in the next 7 or 8 years. And then they have very steep decline rates in the 2030s. And there isn't a Kazatomprom Part 2. And the company themselves are telling us this. They say, looking at global demand projections for nuclear energy, we need another 1 or 2 Kazatomproms in the next 15 to 20 years, and those don't exist. So they really see a higher price environment, and we'll get to the contracting terms a little bit later. But then we get it to Cameco and Orano. They have joint venture projects with the mines and the mills in Saskatchewan. The big ones, of course, are Cigar Lake and MacArthur River, both typically in a normal year produce about 18 million pounds a year. Cigar Lake is done in 10 years. MacArthur River, if they do ramp it up to more than 18 million pounds, and they've teased this to the market, that they can produce up to 24 million pounds a year, if they see the signals coming from utilities, and the signals, of course, being signing more contracts at the terms that they want. That's a whole nother thing that we've got to discuss, but I'll leave that there for now. Either way, these are 2 very, very large, very important projects to both Cameco and Orano, and especially Orano. Orano's joint JV in Kazakhstan, Katco, is nowhere near Inkai. Orano got kicked out of Niger. That was about 5 million pounds a year. That's gone for them. They're poking around in Mongolia. I think it's highly, highly unlikely they'll ever get a single pound of uranium out of Mongolia. Of course, China and Russia are going to take that. I think they'll successfully mine uranium there, but it's probably not going to end up in Paris. Then you also have EDF, which is the state-owned French nuclear operator, and they've been life-extending units. They're talking about new builds, yet the state-owned miner, Orano, has a problematic pipeline. So I think what's going to happen there is you have Cigar offline in 10 years, and the McLean Lake mill that the Cigar ore feeds is majority owned by Orano. So they are probably going to be working on developing a project or 2 of some kind in the eastern Athabasca in order to feed ore to replace Cigar. That's neither here nor there. This is all to say, and Orano's borrowing pounds, Cameco's borrowing pounds, Kazatomprom's inventory is at a 10-year low. All of these things are to say that the biggest miners in the world, the Russians are short, they're all having issues with supply. And they all need to spend a hell of a lot of money to shore up their pipeline to be able to maintain production, let alone grow it into this environment that has unbelievably de-risked demand. So supply is going to be, while the demand is de-risked and growing, and that's very bullish and that's great, supply is going to, I think, where we're going to see the right tail disruptions. The market is very, very reliant on a very small handful of large projects that have yet to see a shovel hit the ground, coming online on time, on budget. If any of these don't happen, we're going to see reverberations in the market. I think that's a practical guarantee that happens in the coming years.
And Justin, where do you think the bottleneck is for additional supply from mines? I mean, if you look at NI 43101 compliant or JORC compliant resources, there seem to be quite a few uranium resources around the world. Where's the bottleneck in getting these into production?
The bottleneck is how long it takes to develop the mines and the price incentives to do so. So yeah, you're absolutely right. It's an extremely abundant commodity. It's everywhere. I can throw a stick and hit a little bit of uranium in the soil. It's everywhere. But the price incentives to pull it out of the ground are not there yet. The cheap projects and the state-owned projects are the ones that are doing what they can to develop and ramp. So to the Kazakhs, especially the Russian joint venture, you have Orano, like I said, they're pushing in Uzbekistan. Uzbekistan also state-owned. Navoy is the uranium miner there. You have a few other, state-owned entities that are pushing to ramp supply, and they're going to be able to marginally. But for the rest of the world, the publicly traded companies, if you look at what has happened to the shares of the companies that have attempted to bring production online, they've all been slaughtered. It's been a very, very difficult environment for brownfield restarts and for any greenfield development at all. And so there's just not the incentive there. I mean, you can even look at, I'm not going to mention the company specifically, but there's a company that's recently started production over the last year or so that has all-in sustaining costs of production at less than $40 a pound. They're selling at $65 a pound. They're still operating at a loss. So you have fully allocated production costs that are way, way higher than those all-in sustaining costs, and those have to be factored into the contract terms. And this is why you have entities like Cameco that are wanting majority market reference contracts with ceilings as high as 140 and possibly even higher, where we're sitting at $76 spot and $85 term. It's like, well, why the hell are they asking for those terms? Well, it's for obvious reasons. They have a pipeline problem. They need to invest billions of dollars to replace Cigar Lake in the next, and it's offline in 10 years, which means they need to start developing that new big thing to replace Cigar in the next 3-4 years. I mean, it has to start very, very soon in order for this to actually happen. And they're not going to do it by selling uranium into this environment. And they're holding out. They're holding strong in as far as they've done a decent amount of contracting at lower prices, which is kind of sort of hurting their uranium business a little bit in the near term, but that goes away in the coming years as the contracts they signed last year, the year before start to play out. And especially if they're market reference and we go higher, which we will. So the real bottleneck for supply has to do with price incentives, especially in the Western world, and it has to do with just the time it takes to develop these projects. And the big one, of course, is NextGen's Arrow. That's according to the feasibility study, 29 million pounds a year. It's going to take 48 months to develop. And if we assume that they will get their permit in Q2 of next year, 4 years from that is mid 2030, let's say ramp up, perfect scenario that happens, 2031, initial production, maybe they hit nameplate in 2032. The utilities are still banking on 2029 pounds coming out of Arrow, and we're looking at 2032 best case scenario. And here we are where NextGen has an unbelievable amount of leverage and power of the narrative to say, okay, well, that was our feasibility study, but based on the market conditions, and we're wanting to build a smaller mill. So we're going to build a mill that can handle half of that. We're going to be producing 15 million pounds a year. And based on the delays and just the struggle that we're having, I'm just making up the narrative here, but they have that power of the narrative. There absolutely are problems with skilled labor in the Athabasca Basin. So most industry analysts don't think that they will be able to build this mine and have full production by 2031, 2032. But the utilities believe that they will. So that's a big one. And if what historically has happened to uranium development projects does pan out for NextGen's Arrow, we're looking at 2033, 2034, and probably reduced capacity. And if that's the case, which that's fine for the company because their costs are so low, they're going to crush it either way. But if that's the case, it's going to send a major shockwave through this industry and a major, major price response.
Well understood, Justin. And of course, thus far, we haven't even been talking about a demand-driven supply crunch, which perhaps we can also talk about in just a second. Talking a bit more about this concept of an incentive price. I understand that's a sliding scale. The higher the price goes, the more incentive there is to produce. But what would you say is a good incentive price to keep in the back of your head talking about uranium, where significant additional supply could come online?
I think right now we need to see north of $100 a pound in the term market. I think that we'll see that. I think that we'll see that probably in the next 18 to 24 months. And we're sitting here at $85 a pound. It's up $5 a pound over the last 2 months. I think that this is going to continue to run during this up leg, let's say. But that's where I think the price needs to be in order for projects like Deep Yellow's Tumas, Bannerman's Etango, these large, higher cost open pit mines. There's no incentive whatsoever for these companies to build these mines and then break even. So they're going to want, and I'm not saying that they're break even at 75 or 80. You look at their feasibility studies, their production costs are lower than that. But as I've mentioned already, you have ongoing maintenance, production capex, and you have pipeline investment, and then you have, of course, these are publicly traded companies many of them went through absolute hell in the 2010s. And here they are, and the utilities expect them to produce exactly as what their feasibility study suggests, and they expect them to basically break even. Well, they're publicly traded companies. What do the shareholders want? If you ask the shareholders of Cameco, if you ask the shareholders of NextGen, they're going to say, yeah, we don't even want you to build this damn mine. Like, put it off for 5 years, an additional 5 years, and go half capacity. That's what the shareholders want, because they know what happens to the commodity price when producers actually stick to their guns and try to bring maximum shareholder value. That you see the commodity price go up, you see the stock go up. And I think there's plenty of evidence to suggest that the companies that have pushed off development have performed much, much better than the companies that have rushed into production. as far as the equities go, as far as shareholder returns go. So there's a lot of shareholder pressure right now for all of the to-be developers to kind of keep it under wraps here. Like, there's no reason to rush. Be responsible. Sign the terms, sign contract terms that are going to maximize shareholder value. That's where the pressure is coming from the equity side of things. And yet here we are, we've had multiple brownfield restarts. We've had multiple small development projects start to happen. And the utilities basically expect the equities space to continue to essentially capitalize and fund their uranium. And that's not how it should work. And that's how it has worked in the last few years. And I think that they're in for a rude awakening, but there's a little bit of tension here right now, according to those terms. We can get into that if you'd like.
Yeah, would definitely love to get into that. But perhaps first, perhaps we can talk about the importance of the spot versus the sprot market versus the terms market. You already started highlighting that. And recently you wrote on X that the terms market, the volumes were down 45% year to date, while the price is up $5 a pound. And you wrote, what sort of market structure has a rising price on lower traded volumes? Justin, perhaps you can enlighten us. What type of market structure has that?
Sure, it's an undersupplied market. I mean, that's really what it comes down to. And while this market is extraordinarily complex, there's a lot of moving parts. There's a lot of elements of it that are shrouded in secrecy and under NDAs. But generally speaking, it's still a commodity. Price doesn't rise in an oversupplied market. So there's bearish takes that are looking at certain utility inventories as being stable, that are looking at development projects coming online that they believe will happen soon, and then you can look at what the utilities think, and how do we know what the utilities think? Well, not only do we speak with fuel buyers directly, but we also subscribe to UXC's publication, and what they do is they interview and poll their utility customers twice a year. And so we can see the results of these polls based on what the utilities are sharing. And I've looked at these polls every 6 months for the last 6 years. And what I can tell you is that the utilities basically always believe that the price is going to be relatively close to where it is right now, 5 years out. And they believed that back in 2000 or in 2020 and 2021. And the price just keeps moving higher. And the investors have seen this way sooner, right? So if you go back and look at interviews with Mike Alkin from Sachem Cove or the guys from Segra going back into the late 2010s, and they're out there, they at the time were actually going to these fuel conferences and speaking in panels and projecting what their work is showing. They're saying, guys, we have an undersupplied market. The prices are headed higher. Utilities are like kind of like, screw you. There's always uranium. It's always cheap. Well, they've been utterly wrong, and we've seen the price go from 18 all the way up to 106 in the early part of last year, back down into the 70s here. And the term price has done nothing but chug higher. It goes higher, it consolidates, higher, it consolidates. We just went through about 15-month consolidation period for the term price, and now it's moving up the last 2 months. So really what we're looking at is a rising price environment where the utilities continue to have an enormous amount of bias to what they've experienced over the course of their careers. And we can get into the reasons why this market is utterly different in so many different ways, and why they're going to have to pay the higher prices if you'd like to. But ultimately, price is headed higher whether or not the utilities think that it will. And it's essentially just a structural supply and demand calculation. There isn't enough supply. And when you see low volumes being traded and rising prices in any commodity, that tells you that supply is limited. And that's exactly the situation that we're looking at here.
Well understood. And of course, there is also a thesis for a rise in demand going in 2040, like you outlined earlier. Perhaps you can outline really where that demand would be coming from.
So the rising demand, I mean, when you model demand, you obviously start with the reactor demand. So you have to look at what's under construction. You have to look at what's operating and likely to be operating over a specific time frame. So we take our models out to 2035 with high confidence, have to plug in quite a few things to go out to 2040. Like China claims that they want to reach 200 gigawatts by 2040, 150 gigawatts by 2035. They're basically on pace to do that. But whether or not the construction pace will continue 6 or 7 years from now to achieve those 2040 goals, we don't know yet. You kind of have to plug that in, right? You have to make some plugs for India. You have to make some plugs in general going out to 2040. But let's say for the next 7 years, we feel highly, highly confident in our demand numbers. Going out to 10, few plugs in 2034 or 5, but pretty damn confident in those numbers. Utility demand. The other potential secondary demand drivers are obviously around, but we try not to model for much of that. I think we have a pretty conservative around 10 million pounds of secondary demand on an annual basis, just to plug something there. But we've already seen that number breached this year, based on what the buying of Sprott has done. There's other hedge funds, there's other commodity traders. They've all been buying over the last months. There's a lot of opportunistic buying in the spot market right now, so we're not seeing a panic into the market driving the price to crazy levels. But what we are seeing is when any time a motivated seller comes in with a little bit of excess pounds into the spot market and it pushes the price down $1 or $2, we have buyers stepping in. So really what we're looking at here is kind of a floor in the spot market in the mid 70s, and that floor back in April was in the mid 60s. So we've already seen a big move up. As far as secondary demand goes, we have the potential of financialization, SPUT, yellow cake, hedge funds, anybody else that wants to buy it, right? And that's always there in some amount. Hard to predict exactly what it'll be, but it'll be something. Now, not talking about SPUT necessarily, or yellow cake, although yellow cake holds significantly less uranium and is as an easier takeout target in the future. Hedge funds that buy uranium will sell uranium. So they're not going to hold it indefinitely as SPUT does, right? So hedge fund buying, we figure hedge funds probably own between 10 and 15 million pounds right here. So eventually, as markets go up and markets go down, that some of those pounds come in, some go out. So that cuts both ways. That's not end user demand, let's say, but financialization at any point. Strategic sovereign stockpiling. So this is something the Chinese have been doing for the past decade, right? They've got north of 600 million pounds in inventory of U3O8 equivalent. Now that, of course, includes military stockpiles as well, which have also grown. But those pounds don't leave China. Period. The end. They never leave China. So those are not for sale. They will not be for sale. Now, will China trade uranium? Yes. Will they buy SWU from the Russians and sell it? Yes. So they're not stupid. They're big players in this market. But those strategic stockpiles are not for sale and will not be for sale, period. The U.S. did establish a strategic uranium reserve at the end of Trump 1.0. There's been talks of that. I believe it's coming. Christopher Wright, the Secretary of Energy right now in the current Trump admin, is breathing fire about energy and specifically nuclear energy. He just stated the other day that he expects the majority of the funds available in the DOE's loan program to be used to build new nuclear. But he also has discussed a strategic uranium reserve. So that's something that's coming. We don't know how much money is going to be allocated to it, how much buying they're going to be doing, but it's probably going to be something. We recently heard a representative from the EU say that it would probably be wise for the EU to establish a strategic stockpile of uranium of some form. So could this trend continue? Could other countries step up and actually stockpile uranium strategically? Absolutely. That's all right tail. Strategic stockpiles are not really going to be sold into the market. We've sort of gone through that with megatons and megawatts, the Russian downblending uranium for 20 years, 93 to 2013, 20 million pounds a year into the United States reactor fleet. That ended in 2013. That's not there anymore. That's not happening anymore. You also have potential direct government buying. So not necessarily strategic stockpiling, but talking about actually buying uranium to fuel military and or to fuel, let's say, the nuclear navy. Our understanding is that U.S. uranium stockpiles for those purposes are on the lower end. I don't think they're about to be panic buyers into this market tomorrow, but over the next 10 years, we believe that we will see actual buying of uranium by the U.S. military. Could that happen in any other country? Absolutely. Absolutely it could. So these potential right tail drivers of secondary demand are huge. And then the last one is the big inventory restocking on behalf of utilities. They're not at panic low levels of inventory. They're at decent levels of inventory. Historically speaking, they're on the lower end. And specifically, if you compare their inventory levels to what sort of market we're currently in, I would argue they are very low. And this is why. Secondary supplies have dwindled massively. When you go back and look at historic inventory levels for utilities going back multiple decades, there has always been a huge buffer of secondary supplies, whether it was from megatons to megawatts. Enrichment underfeeding was a big one going back, let's say, the mid-2000s through just even a few years ago. That was 25 million pounds a year of secondary supply coming from enrichers having more capacity than there was demand and actually operating at lower tails assay than what they signed contracts for. And when demand was really low, let's say late 2010s, we saw a decent amount of tails re-enrichments. When there's literally extra capacity of SWU for enrichment, you can take the tails material and spin that back up to natural UF6 and sell it into the market. So tails re-enrichment and underfeeding, like I said, we're 25, 6, 7 million pounds a year for, almost 20 years. And that's down to maybe 10 million pounds a year right now, and probably less. And we think that's basically going away because the demand is so great. There is expansion of enrichment happening, but it's basically in line with the expansion of global nuclear capacity. So inventory restocking on behalf of utilities, on behalf of sovereigns, these are the big right tail secondary demand elements that can happen. Doesn't mean they will happen, but they can happen. And any sort of extra demand on top of just the run rate capacity demand burn up for the global fleet, it's all right tail. It's all gravy on top of what we're modeling. Like I said, we're only modeling for 10 million pounds a year of total secondary demand. Financials, utility restocking, sovereign stockpiling, that's it. And like I said, this year we've already reached that number. I think we're at probably 12, 13, maybe even plus million pounds of secondary demand this year alone. So that's all right tail as far as demand goes.
Justin, what an absolute masterclass on supply and demand dynamics for uranium right here. Now that we've seen a increase in conflict the last few years around the world, of course, thus far we've been talking about uranium markets as a global market. Do you think there's a potential for a differentiated market between the West versus the East, for example, and therefore also differentiated pricing?
There kind of already is. There's small premiums for, let's say, settlement at Converdyn in the United States versus Cameco or Comurex in France. There already is a little bit of a bifurcated market. As far as an officially bifurcated market, I actually think that's pretty unlikely. Historically, it has happened, but it doesn't kind of look like. I think if it were to happen, it would have already happened, based on just the what's happening between the West and Russia specifically, right? So if you want to buy enrichment from Russia, they're going to sell it to you cheaper than buying it from Urenco. And so that's sort of already happening. It's just not an official printed bifurcated market. So I kind of think that's pretty unlikely. With that said, there's actually a Senate bill right now that's going through the Senate that is aiming to add a 500% tariff on all goods coming from any country that does any business, any energy-related business with Russia. So any country that buys uranium or oil, essentially, from Russia, the U.S. wants to slap a 500% tariff on everything that they export to the U.S. So obviously, this is a leverage tool for the U.S. admin to try to end the war and end whatever aggression Russia is still doing towards Ukraine. And that's what it looks like to me. I don't know if it's going to pass. My understanding is it has the president's support. It will still have to pass the House and the Senate. Based on the rhetoric coming from the U.S. admin, it probably could. I think it has a decent chance of passing, but will it stick? I don't know. Probably not. These are pretty obviously very, very, very high tariff numbers intended to scare and intended to leverage. But if the end result is that India stops buying oil and uranium from Russia, I mean, it's going to put a major, major hurt on Moscow. So we'll see. We'll see how this pans out. And if that ends up panning out and it sticks for a minute, then we could see a significantly further bifurcated market. But as far as official price prints, we haven't seen that yet, really, besides just the natural ups and downs of the market based on demand locations.
Incredibly interesting. That had completely slipped my radar thus far, that 500% potential tariff. Talking disruptors for a second, of course, on the negative side, you might have a thorium reactor in China nowadays. On the positive side, small nuclear reactors. I would love to throw that at you at the same time. What do you think of disruptors potentially benefiting or detracting from this bull thesis for uranium?
Sure. The thorium story, I think, is a very, very interesting story, and I'm actually very positive on it for the long term. It's not going to disrupt this current cycle at all. So yes, China does currently have a small molten salt thorium fueled reactor that is operational. I think it went first critical earlier this year, maybe late part of last year. Very cool. Technically speaking, thorium can be used as fuel when combined with a bit of plutonium in any current reactor of any design right now. Zero of them are doing that. And part of the reason is that you have to have some kind of workflow of handling plutonium, of extracting plutonium from a spent fuel. That's complicated and dangerous and mostly illegal in most places based on the current anti-proliferation unilateral laws that have been established around the world. So not everybody can handle plutonium for those reasons, for proliferation reasons. With that said, I'm hugely in favor of future thorium-powered nuclear energy. I hope that it happens. I hope that the recent making available of plutonium to the advanced reactor builders in the US is a hint towards what can come in the coming decades. Hopefully the spent fuel and plutonium can be utilized with thorium, and we can have a thorium-fueled nuclear energy future, in addition to uranium, right? And hopefully that happens. If we start moving quickly in that direction now, it's still not going to disrupt this cycle, because everybody that's operating right now is operating on uranium. To speak generally, nuclear operators don't really love to mess with fuel. So there's various different types of fuel that's out there. They generally kind of stick to what they know is safe, what they know works. What they're starting to do is go to a little bit higher enriched uranium, like LEU+. Requires a little bit more demand on the front end of U3O8 to reach, let's say 6% enrichment, maybe up to 7% enrichment, but they can go longer. They can operate at slightly more capacity factor, and then they can operate for longer periods of time between fuel exchanges, fuel replacement. So that's happening. But as far as thorium goes, I'm very, very optimistic. It's not going to disrupt this cycle. I forgot what your other question. Oh, the small modular reactors and advanced reactors. It's definitely happening. It's moving in that direction. I think that there's maybe a little bit too much excitement and expectations around it. I think that in many ways, it's almost like the climate crisis narrative, in my opinion, takes away from all other environmental concerns, because it's like a myopic view of there's one problem and this is it. In my opinion, there's dozens of environmental problems that are utterly being ignored because everybody's in a climate panic. I think that's kind of dissipating at this point. But that, as a similar example, is the excitement around small reactors is sort of taking away from the fact that we know how to build large reactors and we can just do that. And we should be doing that right now. So not ignoring large and going after small. We've already gone the opposite direction. We started out building small. And because of the economies of scale, we ended up building large. And I'm not just saying we in the US, around the world, right? It's just the general growth of nuclear capacity globally was building small. That worked. Okay, if we're going to build 20 of these, we might as well make them bigger because we already have these supply chains established. So a lot of the inspiration for small right now is because the Western world is afraid of cost overruns. And that's a huge part of the impetus there. Now, I think that there's a lot of cool use cases, industrial heat for the high temperature reactors, for example, like X Energy's reactors deal with Dow Chemical, I think is very, very interesting. The possibility of implementing nuclear energy in smaller markets where you don't have a grid that can take a 1 gigawatt reactor. Maybe you want to do a 50 megawatt. That's super cool. Modular reactors, like a micro reactor on the bed of a semi truck, and to replace a diesel engine. Military encampments, global. Like, there's so many use cases. It's super cool. It's super exciting. But as far as the West expanding nuclear capacity to address the electricity growth, I think should be 95% focused on building more large nuclear, building more AP1000s, building more boiling water reactors. The designs that are already approved, we know that they're safe, we know that they work, we have potentially the uranium for it with enough pricing, enough supply incentive, but I think that's what should be happening. With that said, there clearly is a lot of momentum with SMRs. We're very conservative with how we model SMR demand, and it's happening. I think that there's a few major winners. I think that those are going to be very obvious to the market over the next 5-year period. Right now, we have 80 different SMR designs, 85 with, or more than 100, excuse me. There's 80 something companies. Some of them have 2 or 3 designs, more than 100 designs. And I think that there's going to be less than 5 actual winners that take the majority of the market share. And I think 2 or 3 of those are extremely obvious already. Yeah.
Excellent. I would love to squeeze in one more question, being conscious of the time. Perhaps we can talk about a situation where, Justin, you wouldn't have a portfolio of junior companies, of uranium companies at all. How would you go about constructing a portfolio? And please use the opportunity to talk about the Uranium Insider as well.
Sure. How would I be constructing a portfolio without any uranium?
Exactly.
Is that your question?
You don't have any uranium right now. How would you construct a portfolio to make use of this trend?
Well, I can tell you what I personally own aside from uranium, despite the fact that my largest holdings are uranium based on my bullish outlook and that I know this market the best. So, and that's
what I'm trying to get at, Justin, is let's say you didn't own any uranium associated companies or equities. How would you construct a portfolio today?
Oh, I see. Okay. How would I establish a uranium portfolio today? Got it. I apologize. I misunderstood your question. I would, right now, especially after the run that we've had this year. So the spot price is basically flat year to date. URNM is up about 35%, even after falling 20%. So the equities have run despite the fact that the price hasn't really moved. Now the long-term price has started to move. But what that looks like to me is a huge, huge opportunity for owning physical. So I think that every single portfolio should have at least a large foundational position in either Yellow Cake or the Sprott Physical Uranium Trust. Or if you have enough capital and you want to establish an account at one of the conversion facilities, literally go in and buy uranium in the spot market. Go buy 50,000 pounds and hold it at one of those locations. I think there's an unbelievable opportunity to own physical here. As far as the mining stocks, I think it's unbelievably critical to diversify. This is the biggest problem that I've seen for retail, and there's many retail investors that have been blown up by the pullbacks in this market because they got super excited about 1 or 2 names and went all in. And usually the excitement has to do with the undervalued smaller cap explorer stocks, which the market clearly does not want right now. So I think right now what looks very tantalizing is physical uranium or SPUT and a basket of the small caps. And especially over the next month or so, because next 6 weeks, because we're going to see a couple of things that are going to happen. URNM is changing its, the index that it tracks is changing its prospectus and its inclusion requirements. So it's going to be dropping a number of small cap names out of the index. That's selling pressure. We also have big returns for both URA and URNM this year to date. So we're going to see dividends being paid out in December. And last year, was that last year or the year before? I think it was the year before. We had the similar kind of shakeup in December where some of the dividend payouts, they had to sell down their holdings in order to fund those dividends. But I don't think the Sprott ETF, I don't think URNM did that. They came up with the different mechanisms to do so. But there should be some selling pressure coming from the ETFs in December. And I think it's going to hit the small caps harder than everything else. I don't have a crystal ball. Maybe we'll see buying pressure between now and then. Some of the small caps that have underperformed and are actually down year to date could actually see tax loss selling as well. So between those different elements, I think establishing a diversified exclamation point basket of small caps over the next 6 to 8 weeks is a very, very interesting thing to look at. Besides that, we generally like to hold and own real companies with responsible management that is well capitalized, has played the capital market well, and will be producing something in terms of cash flow over this cycle. I think that ultimately, while we have speculative fervor going into certain particular meme stocks and the last legs of this market, we've seen much more love for the mid and large caps and the liquid stocks. Eventually, I do think that we will see something like we're seeing in the gold market right now, which is the gold mining equities that actually are producing or will be producing cash flow at this, $3,800, $4,000 an ounce gold. Those stocks are getting some love finally. And I think that will ultimately happen in the uranium market. We'll have the half dozen companies that are producing an enormous profit. They're going to be very, very rewarded by the market. Now, is that happening now? No. Will it happen in the next 12 months? Probably not. But ultimately in this cycle, I think that's where you want to be positioned, is physical and the companies that will produce something. With that said, like I mentioned, the small caps are just being thrown out with yesterday's garbage. So a basket of small caps, I think, is a wise thing to establish in tranches over the course of the next 6 or 8 weeks, was something that I would be looking at.
Justin, I know you need to run, and we'll put the links in the description, but please shortly talk about the Uranium Insider.
Sure. It's an investing newsletter we established in August of 2019. Since then, we've outperformed spot uranium by a factor of 2. We also have a trading portfolio that's up about 60% year to date. We're using the volatility of the market to our advantage with this trading portfolio that we established earlier this year. That's worked out very, very well for us. Have a small team behind me. We've been doing this, like I said, for 6 years. We're 100% focused on it. We put a lot of energy and effort into understanding the physical market. And that does a lot to inform us of how we trade this market as well. We have to see what's happening in the spot market and in the term market to gauge where we think things are moving in the short term. It's a lot easier to look at a 30,000 foot view and look at all the bullish demand factors and look at the supply constraints and say, okay, we're generally going higher. It's absolutely true. What's happening next week or next month is much, much more difficult. And our clues from the physical market definitely help us there. So we try to take all of these difficult moving parts of this market, distill them down to what investors need to know in order to manage their own capital as they see fit with their allocations of this sector.
Perfect. Thank you so much for your insights and your time today, Justin. Tremendously appreciate it.
It's been a pleasure. Thank you for having me on.
This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their SEDAR+ at www.sedarplus.ca.